Is the age of the department store over? Honestly, when was the last time that you went shopping at a department store? And, when you hear news of a department store, it is usually about how many stores they are closing. In fact, who really even shops at department stores anymore? Not surprisingly, Kohl's is no exception. It faces rising costs at a time when consumer demand is plummeting. Are department stores in terminal decline? Or will they somehow make a comeback? What does it mean for the US economy? And what does it mean for the future of the United States? But, before we get into all of that, please hit the like button and leave us a comment below. We would love to hear from you. Please subscribe and hit the bell icon so that you are notified of upcoming videos when they are released. All department stores seem to be in some version of decline. This is very much like the shopping malls in which they are located. Maybe the fate of shopping malls and the fate of department stores are inexorably linked. Kohl's seems to be the latest department store whose death throes seem to be surfacing and disappointing shareholders. Kohl's is having to deal with both rising input costs and declining consumer demand. Add to that, Kohl's lost its investment grade rating. And this means that borrowing money will be even more expensive. COVID-19 lockdowns in China are another factor affecting Kohl's. This is because much of Kohl's merchandise comes from China, especially clothing and shoes. Kohl's cash position has continued to deteriorate. And, its inventories remain high at a time when management is looking to bring in merchandise for the upcoming holiday season. Most Wall Street analysts have come to believe that things will get worse before they get better at Kohl's. And that Kohl's stock will continue to decline. The global economy is teetering on the brink of recession. And consumer discretionary spending has softened significantly. Inflation is raging. And the Federal Reserve is aggressively raising interest rates this year in order to fight inflation. Rising interest and softening consumer demand are bad for retail stores in general. And they are even worse for department stores because of their already weak position in the retail ecosphere. Consumer discretionary spending is experiencing dramatic pressure. Investor sentiment is turning against retail in general and against Kohl's in particular. This means that stock multiples are low and getting lower. So, retail stock prices are trending lower. Kohl's stock price has plummeted almost 50% this year so far. That makes the dividend yield 6.5%, which seems very high. So, on the surface Kohl's seems like a low-priced value stock. That it may actually be a value trap. Trying to buy on the dip may actually be trying to catch a falling knife. Investors need to take into account the possibility of financial restructuring to reduce the debt. That is a typical next step when debt and revenue get out of whack. Investors cannot just simply assume that stocks that go down always bounce back. Because stocks that go too low eventually get delisted from public exchanges. While there is potential value in Kohl's, I believe the stock is among a growing number of value traps. Kohl's seems to show all of the signs of becoming a candidate for bankruptcy. For example, it has high debt and its credit rating has been reduced. The reduced credit rating and higher interest rates essentially mean that Kohl's cannot borrow more money. So, profit margins, which are already thin, are going to get thinner. The entire department store category is struggling to survive. Online shopping has grown in acceptance and popularity and has taken away market share from brick-and-mortar stores. Inflation is raging and energy prices are higher, two factors that favor online shopping over brick-and-mortar stores. Actually, the best economic tailwind that Kohl's has is the bankruptcy of competitors in its market space, such as JCPenney. Also, e-commerce networks like Amazon have a much more efficient distribution network than department stores. If inflation continues, especially in labor and energy, Kohl's will likely be driven into bankruptcy. Department stores do have some advantage in that they allow customers to try on clothing before buying. But, e-commerce giants like Amazon have lenient return policies and many customers just return clothes that do not fit. In Kohl's Q2 earnings call, the CEO made a point to note that shipping and freight costs are weighing heavily on margins. Freight costs move with oil prices somewhat. But long-haul truckers are experiencing a shortage, which is driving up costs for shipping. Overall, Kohl's has done a pretty good job in keeping a lid on shipping costs. But, day-to-day operating expenses have been increasing. Kohl's corporate operating expense ratio is going to rise because of wage pressures. But, operating margins will get squeezed because prices for clothing and shoes are increasing. It seems as though the pandemic-era stimulus made Kohls look stronger and healthier than it is. COVID lockdowns in China continue and show no signs of stopping, and that is also hurting Kohls. Most of Kohls' products are made outside the US, mostly in Asia. Some higher costs can be passed on to customers. But, eventually demand destruction kicks in as consumers' budgets are squeezed. Food and energy are more expensive. And, the wave of layoffs has many people afraid of losing their jobs. Because it operates on such a thin profit margin, typically 3%, a small change can erase the profit. Kohls has a lot riding on the upcoming holiday season. If the holiday sales season is not strong, Kohls could find itself with too little cash to operate. Kohls will have to sell sufficient inventory during the holiday season to avert a cash crunch. Kohls does own much of the real estate on which it operates, but not all of it. So, there is some interest on leased land to consider. Banks might not be very forgiving if Kohls breaks loan covenants, and this could trigger a bankruptcy. I would not be surprised to see Kohls in bankruptcy court seeking restructuring within 2 years. There does not seem to be much that management can do about Kohls' conundrum. There was a recent attempt to sell the company. But the buyer reduced its offer by about 10% as the Federal Reserve began aggressively raising interest rates. Because the offer was reduced, Kohls backed away from the deal. This will probably turn out to have been a mistake for Kohls. Actually, it is probably not a phenomenon that is unique to Kohls. But, the era of the large department store looks like it is finally ending. The financial cards are just not there for the entire category to continue, despite the fact that some customers still love department stores. There may be a few surviving department stores that are in a unique niche or have special luxury items. But Kohls is not in either of those categories. Kohls could sell off its e-commerce division and some of its remaining real estate holdings to shore up its cash position. Kohls might be able to use financial maneuvers to buy some time. But, the destination seems determined. About 40% of the department stores in the US have closed in the past 6 years. Nearly every Lord & Taylor store has closed. Many Sears stores are closed. About half of the remaining 1,600 mall-based Sears stores will be closed by 2025. JCPenney has some stores remaining. But the company is not doing very well with those stores. What do you think? Please leave us a comment below. We would love to hear from you. Please hit the like button. Please subscribe and hit the bell icon so that you are notified of future videos when they are released. Please share this video on social media. Thank you for watching.